The discount rate, one of the most important concepts in finance. It's used in financial analysis like the discounted cash flow model to calculate the intrinsic value of a company. It's widely used by investment banks, private equity firms, and famous investors like Warren Buffett and Charlie Munger to make billions of dollars in profit. But what exactly is the discount rate? And how do discount rates work in the stock market? To understand the discount rate, we first need to understand the idea of the time value of money. Simply speaking, the time value of money asserts that money today is worth more than money later. Here's a quick example. Imagine investor A is given two choices: get $100,000 today or get $100,000 next year. Of course, investor A chooses today. Why wait a whole year just to get the same amount? Now let's change the offer. Get $100,000 today or get $101,000 next year. Investor A still says nah and chooses the $100K today. That extra 1% isn't worth the wait. So we keep increasing the future offer until investor A finally agrees to take up the offer of waiting one whole year to get money. We keep going and, oh, wait. Investor A agrees to wait one whole year to get $110K rather than taking the $100K today. So what just happened? It took increasing the future amount of money by 10% to convince investor A to wait one whole year. That extra 10% represents the discount rate. In other words, the discount rate is basically the return an investor wants in order to make waiting for future money worth it. In the real world, this is exactly how the bond market works. In the bond market, banks sell bonds or CDs at a specific interest rate, like 4%, to convince people to put their money away for a year or even multiple years, just like how we managed to convince investor A to wait for a year. So basically, the discount rate is just the percentage return an investor wants in order to make investing worth it. Once you understand this key basic fact, understanding how the discount rate works in DCF models when valuing stocks actually becomes very simple and intuitive. To help you understand how a discount rate works, let's continue the previous example. Let's say investor A sets a discount rate of 10%, which basically means that he wants a 10% return to make investing in a company worth it. Investor A searches through a list of companies to invest in and checks their financials. He finds a company called ABC, making $100,000 per year in cash flow and is trading at $500,000 in the stock market. The cash flows don't grow or shrink. ABC just keeps making $100,000 a year forever and will never go bankrupt. How do we calculate the intrinsic value then? Well, we can use the DCF formula. This might look complicated, but the formula simplifies to this. And since the cash flows don't grow or shrink, it means that G, which is cash flow growth, is 0, which turns the formula to this. Where TV is the intrinsic value, FCF is the cash flow, and R being the discount rate. Since investor A has a 10% discount rate and the company makes $100,000 per year forever, then ABC Grocery's intrinsic value is $1 million. This means that investor A needs to buy company ABC for $1 million to get the 10% return he wants, which is the discount rate. But ABC is only trading for $500,000. That's half of what investor A believes it's worth. So does that mean he can make an easy $500,000 profit since the intrinsic value is $1 million? Not exactly. The difference between the intrinsic value and the market value doesn't signify the profit investors could get. Instead, it tells us how much higher or lower the actual return will be compared to the return you were aiming for, in this case 10%. Since the $1 million intrinsic value is 2 times bigger than the $500,000 market value, then this means that investor A's return is going to be 20%, which is twice the discount rate of 10%. This makes complete sense. If you invest $500,000 and get $100,000 a year, that's a 20% return on your investment. So to sum up, the difference between the intrinsic value and the market value tells us how large or smaller your actual return is going to be compared to the discount rate you set, which is the return you're aiming for. So by buying a company at its intrinsic value, then that just means your return is going to be the same as the discount rate. However, if you buy a company trading below its intrinsic value, which means it's undervalued, then that means your return is going to be way higher than the discount rate. And vice versa. This way of thinking about the discount rate is exactly how private equity firms make billions of dollars. They don't evaluate investments based on the difference between intrinsic value. They look at the implied discount rate from investing in the company. That's why PE firms have enormous discount rates, ranging from 15% to 30%. So the next time you look at a DCF model, don't look at the intrinsic value. Always look at the discount rate, because whatever price that was calculated in the DCF reflects the price you need to pay to get that return equal to the discount rate.